Welcome back to the IB Investor channel. In this video, we'll take a look into the Swedish heat pump manufacturer Nibe. The company was founded in the year 1953 in Sweden. It is currently co-owned by the current and former board members and senior executives that holds roughly 46% of the capital. In addition, the investment company Melker Schörling owns 18.68%. It is quite a big company. It has a market cap of 129 billion Swedish kroners or 11.7 billion US dollars. The company offers a 1% dividend yield, which isn't huge, but it is a fast-growing dividend company. So even though the yield is low, it will probably grow pretty fast from here, but we'll see. The growth of the share price has been pretty impressive, I would say. It holds a CAGR for the past 10 years of almost 24%, which is really massive, I would say. We also have a company with a quite low net debt to EBITDA at 1.1x. It currently holds 125,000 shareholders, so this is one of the more commonly owned shares on the Swedish stock exchange right now. The company has three large business areas. The first one is the climate solution one, the second one is the elements, and the third one are the stoves. It currently operates in 40 different countries worldwide and has somewhere probably north of 21,300 employees as of right now. Continuing with the business areas, we can see here on the left slide that the climate solution business is by far the biggest one. In the current second quarter here, they had a 7.7 billion Swedish kronor worth of sales, followed by Nibe Elements that accounts for roughly 3 billion, and then the smallest one actually, Nibe Stoves, that sits at 1.2 billion Swedish kroners. We can also see the operating profit here on the lower side. And just a hint here that the climate solution one, even though it's the biggest one, it's also the most profitable one with a operating profit margin of 17.4%, if I calculated this correctly, in the latest quarter, I would say, or most recent one. The stoves is the second most profitable one with an operating profit margin of 13.2%. And the middle one, the elements, is the least profitable one with an operating profit margin of 9.3%. On the top left corner here, we can see the net sales that grew almost 23.5 billion, which is really strong. It is up more than 27%. And keep in mind that this company is a 129 billion market cap company, so growing this fast is actually quite impressive. And we can also see that for the full year 2022, they grew by 30%, and for the past 12 months, they grew 30.4%. So it's actually picking up a little bit here for the past 12 months, but for the most recent ones, it looks like it's actually going down a little bit. We can also see that the profits are growing quite nicely. So profits after net financial items improved almost 37% in the first half, which is, of course, very nice. So well done management here. The EPS is also up approximately 38% as a consequence. We can also see on the bottom left slide that the net sales are trending up nicely. This is often what investors like to see. And on the right-hand side, we can see the profits after financial items. And this is actually a little bit more sluggish. It's going obviously more up and down in the long term, but there has been some quarters, for example, in Q1 2022, where for some reason the profits were almost, I wouldn't say eliminated, but they went down somewhat, and then they recovered quite well in the second quarter. On the top right here, we can see the regions of group sales, but it's really difficult to see actually. They should have chosen different colors. I'm not sure what they're doing here, but yeah, anyways. Now let's take a look at the management operating performance. So we can see here that the return on equity grew double digits here in the trailing 12 months, which is equivalent to 18.43%, which is quite good. We can also see that the return on equity has been double digits across the board, looking back a few years. So even all the way down to 2017, they still had double digits, but it's not so high. I actually would have expected this company to have higher return on equity. So, but I mean, it's still high, so nothing bad, I would say. On the return on equity side, or return on invested capital, it is sits at 13.68 right now. So that's okay. It has improved as of late, but we can see here and for example, on the left side here in 2017 that it was as low as 8.62. So they have almost doubled that of today, or not doubled, but almost. So they're doing better and better, I would say, but it's okay. Now again, looking at management performance here and the operating margin here, we can see that it's double digit again, which is good, almost 14%, which is, by the looks of it, the highest that they have recorded. Mind you that this is the trailing 12 months and not just the most recent quarter. We can also see that the net margin is steadily going upwards compared to, let's see, the lowest one we're here in 2019. And we can see that it has grown ever since, basically. This could also be the case that perhaps that management has acquired more profitable companies that has better margins. I'm not sure. I haven't really looked into previous annual reports, so it could be that they have acquired this higher net margins, but yeah. But anyways, it looks good regardless, and if they can keep this, it's obviously super, but I'm not sure how sustainable it is, since it currently sits at almost all-time high levels compared to these past 5 years. Looking at the cash flows here, the cash flows from operations has increased by 33% for the comparable period, which is obviously really good, and especially in times like this where inflation just bites into everything. It's really good here by management that they managed to increase the cash flows for the comparable period. Now for the dividend, guys, we have a dividend slide here where we can see that management, or actually the board, has decided to pay out some nice dividends across the years here. So they have a pretty strong dividend track record, as I can see. They've also raised the dividend, the most recent one at least, by 30%, which is quite strong. They also didn't have any COVID-19 pause, but rather it looks like the board had really good confidence in the business going forward. So there were no pauses at all for the 2020 figure here, as we can see. So that's always nice, and see, that management has confidence in the business and that they're able to pay out dividends even during times of stress. So that's certainly a quality stamp from my point of view. Looking at the share price here for the longer period, we can see that this stock has been an absolute machine for many, many, many years, and it's made the investors very rich. And I read some stories where even some of the employees have actually become billionaires as a result, thanks to the massive return as this stock has performed over the years. And as we can see here on the bottom slide, the stock has performed a 23 3,000% return during this period. So it's just massive. And obviously, I wish maybe my parents would have bought this stock for me. I would have probably been a millionaire, obviously a multi-millionaire, even with small sums of money. A 23,000% return. That's a crazy figure. But this is the Nibe company, and the stock has performed really well. I'm not sure if it's going to do the same in the future, but it certainly has been a good stock to hold until now, at least. Now for the risk of this company, or some risk going forwards. This company has traded for very high multiples for a very long time. It currently sits at roughly price to earnings ratio of 26, so it's far from cheap. We can also see that the stock price, even with this P multiple at 26, the stock has fallen more than half since the end of 2021. So the company was massively overvalued just a few months ago or some year ago. So it comes from a very high level. The price has come down, but it still trades at quite a high multiple still. There's also some risk here regarding the CEO, who's 72 years old. So obviously, and that CEO has run this company for many years. And obviously the question is, what's going to happen when he decides to leave his position? I mean, of course, he could perhaps become a chairman or something like this, but he is, even as a chairman, he's quite old at 72 years old. So that's obviously a big risk. What's going to happen? There are quite big shoes to fill in his absence. Also, the last point here that I want to highlight is that there's been some subsidies halt in Europe. There are some discussions going on, as far as I'm aware, regarding changing the heating systems in many of the old homes in Europe. And for example, in Germany, the government has announced that it will cover roughly 70% of the cost of a new sustainable heating system from 2024. And that, of course, is something which Nibe could really gain a lot of market share from, but I'm not sure whether or not this is decided. So I think that this puts a pause on many people's purchases right now, whether the governments will grant them this money or not. So if they won't do this, I think that the upside, of course, for people to buy a new heating system is massively reduced. But yeah, we will see. For the positive side of the stock, I think that management could do something here about the margin expansion still. There are some peers within industry companies that has increased their margins even further. So there could be some potential here that they could stretch the margins a little bit better, I would say here. We also see that the net debt to EBITDA is quite low. It currently sits at 1.1x. So this leaves plenty of room to make further acquisitions if they please, because the balance sheet is quite protected as it is right now. So no big risks there right now. They do have very good positive product trends. I mean, the heating systems and the heating pumps that they offer is certainly in line with what's this buzzword of transitioning or sustainability. So they certainly have the market trends here in their backs. Many countries still uses oil, for heating in their homes, and that was the case in Sweden not many years ago as well. So it's quite normal in many households in Europe to use oil, and I would suppose that even in the US it's the same. And Nibe offers heat pumps, which is more and more accepted in European and US homes. So I think that they have a large market here to exploit if the opportunities would arise from, for example, if the government steps in here and subsidize these kind of transitions. It's also owner operated with very strong owners, as I mentioned. especially I would say Melker Schörling, which is an investment vehicle owned by the same family, basically the Schörling family. They have a lot of money, they have a lot of capital all across different investments. So I think if this company would ever come under stress, I'm pretty certain that that family at least would be able to step in and possibly save this company. But as it is right now, I don't really see any risk of that with the net debt being quite low here, to be honest. This was it for this video. I would like to thank you for watching. Please follow and subscribe for more content if you want. And if you liked the video, please hit the like button below. Thank you very much. Bye-bye.